Today we are going to look at the actual annual performances of different global funds so that you can see how different or similar these really are. I get lots of questions about which global fund to buy and whether it is worth owning multiple funds just to be safe. My personal take is that it's probably not worth owning multiples because you have so much overlap. But I thought, let's just show you the data and then you can make up your own mind. As you know, this isn't investment advice, I'm just sharing information as I study to become a qualified financial advisor. Let us start with the cheapest option on my list, PACWI, which costs just £7 for every £10,000 you have invested per year. That is a 0.07% ongoing charge to own a tiny piece of 3,500 companies of large to medium size, and to actually locate this specific fund on your investment platform of choice, your best bet is to use the ISIN code, which is a unique reference number I will share on screen. Over the past year, its return sits at an impressive 31.37%. Now, to clarify, that figure includes both share price growth and dividends, which are the two ways you can make money through investing in the stock market. And the reason that I do not personally have this particular fund within my portfolio is because it is an income rather than accumulating fund. And this means it takes those dividends and pays them out to you as cash. Now, while that is really useful if you are trying to live off your investments, it isn't as efficient if you are still in the growth phase and building up your portfolio, as I am. And to get the most out of your investments and keep that compound interest going, with a fund like this, you would actually have to manually put those dividends back in. Now, sometimes there can be a setting on your investment platform that can help with this, but I personally do prefer a fund that reinvests it automatically for you. The next fund we are going to be looking at is LGGG, which will cost you £10 per 10,000 invested each year. It has 1,382 holdings, which is less than half of the previous fund because it excludes emerging markets. Now, this particular fund only tracks developed market countries and actually excludes also companies engaged in things like pure coal mining or controversial weapons. As a quick tip, if you ever want to check this for yourself, just read the summary section of the fund's fact sheet, usually found under the investment objective heading. It'll get you a feel for the point of the fund and also what it is trying to track or replicate. And if you prefer a fund with a bit more of an ethical selection process, then this might appeal to you. But then it does also have, on the other hand, less spread or rather diversification than the previous and other options on this list. Its one-year performance came in at 29.31%. Next up is ACWI, which is the global fund that I personally picked for my own portfolio this year. It has 2,000 holdings and perfectly hits my criteria because it is accumulating and it does include emerging markets as well. Its cost is £12 per £10,000 invested over an annual period, making it a middle ground option for convenience, cost and diversity. I kind of see it as the Mario or all-rounder of the bunch. And this is the exclusive holding for my Trading 2 and 2 stocks and shares ISA, and its one-year performance was 31.28%. The three funds we've discussed so far are all ETFs, but next I want to show you two global index funds. Now, the main difference between an ETF and an index fund is simply how often they are traded. Index funds trade just once a day when the market closes, whereas ETFs trade continuously throughout the day. And this means, basically, if you log into your account to check an index fund during the working week, then the value won't be changing until the market closes that day, which can sometimes make it feel more stable rather than seeing the constant ups and downs of an ETF. And When I first invested in an ETF, it did feel a little bit strange because I could see the constant shifts in valuation from literally 1 second to the next, which I hadn't been used to from my experience investing in index funds. However, I soon got used to it when I actually understood the reason for that. And now I personally choose what to go with based on other factors. So not really whether it's an ETF or an index fund, but more like, is it available on my chosen investment platform, and also the total cost for me to invest into it. Now, looking at index funds, we have the HSBC FTSE All World Index, which I actually own within my lifetime ISA on the Doddle platform. The charge for the fund itself creeps up slightly to £13 per 10,000 invested over a year. It holds 3,466 companies, is accumulating, and includes emerging markets. Over the past year, it returned 28.3%. Finally, for the sake of having a truly comprehensive global fund, I've picked out the Vanguard FTSE Global All Cap Index Fund to compare. And while the previous options do focus on large and mid-sized companies, this fund actually incorporates smaller companies into the mix as well, bringing its total to 7,464 holdings. Now, because of this massive inclusion, the cost is higher at £23 per £10,000 invested for a year. And that is more than 3 times the cost of our first option. So returning 28.87% over the last year, you have to make, of course, a judgment call on whether it's worth that additional charge to incorporate all of those additional small cap companies. And as a quick note on all of these numbers, the performance figures you are seeing already have that ongoing fund charge kind of baked in. But remember, depending on your provider, it might not just be the fund charge that you've got to think about, because you might still have to pay a separate platform fee on top. Now, some of you might have already been thinking this, or even left a comment if you haven't watched this far, but the other major difference here is not what these funds are invested in, but the base currency of the fund, because the 3 at the moment that look to be the best performing actually just report their performance in USD as opposed to Great British Pounds. And once we have actually kind of factored in for this and the currency fluctuation over the past year, we can see that the actual performances are extremely similar across all of these funds. And that's because the pound simply got stronger against the dollar. And so selling the dollars today would give you slightly less pounds back. And we can see here, when I put them side by side, that they are very much on par with one another. Just please note that these currency conversions are approximations rather than the exact results. Now, you might have noticed that one fund of the bunch was slightly lower, getting stung a little bit in this particular year for being that bit more selective and choosing to exclude emerging markets. But one obvious and important caveat to make is that just looking at the last year's performance, of course, isn't enough to determine which is best, because market patterns change and the companies that performed the best last year won't necessarily perform the best next year. So when you look at all this data, the main takeaway is that these funds are actually very similar to one another, as is their performance. I often talk about designing a simple investment portfolio that you can actually stick with. And a single global fund is still, in my opinion, the perfect set and forget strategy. And it is the most hands-off way you could possibly invest. Now, if you start obsessing over comparing global funds or chopping and changing them, then I believe you lose the best part of this strategy and could actually risk missing out on big gains while you are out of the market entirely or still grappling with the decision of what to do. But you do still have to come to a decision, and all of the things I've talked you through today are the steps you can use to differentiate between them. In summary, you want to look at how the fund deals with dividends, the ongoing charge, whether it includes emerging markets or has specific exclusions, the base currency and how that exposes you to currency fluctuations, how they are available on, or whether they are available on your platform of choice, and how they are traded. And platform fees are a whole nother topic. But hopefully by now you have enough information to make your own informed decision on which global fund you want to choose. But if you ever are in doubt, you can always check out my financial coaching service, which I offer to help generate bespoke financial plans for people and to work through indecision and into action. Check out the link in the description for more information. Thank you for watching, and I will see you in the next one.